Friday afternoon, kind of recap, look a little bit at this week and how it looked for trades and festivities, and then we're going to talk a little bit. Troy has done a little bit of research on history of Fed and how it's affected the market a little bit. He's going to bring up a couple studies, and then I will go over 2 or 3 trades. What's the plan for next week? What trades based on last week, this week? What do I think? 2 or 3 trades. What my plan? What days I would put them on? What's the news next week? And so we'll be ready for next week. But first of all, real quick, to me, I'm encouraged as a range-bound trader. The last, let me just share here. Can you guys see? You see my screen?
Yep.
Okay. I mean, as I'm looking my trade log for the trades that we put on in class every day for the various classes, you could see, I mean, minus would be loss. This was a 1% loss, but most of the dates putting trades on almost every day, mostly greens. And, even in the chaoticness of the last 2-3 weeks, even for the range bound trades, they've been going well. This week, Troy, I think what's encouraging to me is we stayed in the expected range, right?
Sure.
I think 3 weeks we've moved outside of it. I think things are slowing. I think we'll be in the expected range next week. So this week, from last Friday till today, the expected range, we're not done with the day yet, is 50.18 to 51.82. So, we're basically going to be pretty close, not far off of the middle, but in the expected range. So the expected move was, I believe, plus or minus 80 points or so. So I think next week should be, earnings are done with. And a lot of the big news events, I'm going to check while you're going over the Fed stuff for next week. But I'm anticipating next week to be another good week for range-bound traders. And when I'm talking about after Troy, I'll go over trades for next week, and I'll be mentioning how the trades were doing this week. So I'll kind of bring that both together. So I'll bring up trades, actual trades I'll be looking at for next week, which some were similar to this week. So Troy, why don't you go ahead and speak on the Fed, and then we'll go from there.
Sounds good. Do you mind sharing my screen, Dan?
Yeah. Let's see. Do I maximize the one with your face or the other one? There's 2 Troys.
Oh, don't maximize my face.
Oh, yeah. Don't maximize my face. I like that. No. All right. We can see your
Okay,
screen.
Cool. So basically, I wanted to look at some back tests, 2 in particular, and I wanted to get your view on it, Dan, because it's interesting to me. I know a lot of people are scared of trading, on Wednesdays, in particular, for particularly 0-day stuff, because it can be crazy, right? And you can have a great day, you can have a terrible day, sometimes at the same time, or minutes apart, depending on what I was saying. And so I wanted to show kind of 2 trades, and I'll kind of show what I've done. So
and you're talking mainly that Fed Wednesday.
This is basically a list. This is a list going back to 2021 of every Fed FOMC conference. So
everyone, okay.
The days where Powell gets up and speaks.
Okay.
And there's one of 2 trades here. So basically how we do this is, we set up the dates and we put specific dates, and we have a list of dates that we want to test only. So this is a 0-day trade, but what I'm doing basically is I'm putting it on at 2:05. So 5 minutes after the Fed announcement, but 25 minutes before Powell starts talking. And this is a 100% mean reversion trade. So what I'm doing is whatever the current day's open is on that Wednesday, if we go up a 0.5% up or a 0.5% down from that trade, and at 205 we've gone up a 0.5%, I'm going to sell the opening fly. So wherever the current day's open was, I'm going to sell the equivalent of like the 50 delta. And I'm going to go 25 points wide. So I'm going to buy the put and the call 25 points out.
Mm-hmm.
And all I'm doing is I am getting a 5% profit target. I just want 5%. It's just a real quick reversion trade.
So Troy, just so I understand, the trade's going to be put on, like Powell speaks generally at 1 Central, right?
Mm-hmm.
So you're going to put the trade on at what time?
You're going to put it on. Powell speaks, I think, at like 1:30 Central. Is that right?
The speaking part. Yeah.
So you're going to put it on 5 minutes. So 1 o'clock, 1:05 Central. So 2:05 market time.
Okay.
So 5 minutes after the market has received whatever the news the Fed's going to do.
Yeah.
We're going to revert. We're going to just put a fly on at the open. If we have gone up a 0.5%.
When you say a fly at the open, what do you mean by that? Like we're putting the trade on in the afternoon.
Yeah. So what you would do in this case is you'd say, okay, let's say we open, just for ease of sake, we open at 5,000.
I got you.
And at 2:05, if we're up a 0.5% from 5,000 or down a 0.5% from 5,000,
yeah,
we're going to put this trade on, but we're going to center the strikes at around the 5,000 strike.
Oh, where we opened.
I
got you. So if we go up 5% to 5,025 or something.
Exactly. Yeah. Wherever 0.5% would be in.
Yeah. I got it. And then you would just revert. You would put wherever so basically you put kind of the low of the day or the open, not necessarily the low of the day. It would be where we opened.
Yeah, no, that's exactly right. So you're just going to sell the fly wherever we opened, wherever that strike. Yep. And so you're going to take 5%.
When you say sell the strike, when you say sell the fly, I'm used to like if I buy, I'm used to like buying a call fly or a put fly. That would be a debit. If you're saying sell it, do you mean like an iron? So that'd be like an iron butterfly at that strike.
Yeah, this is an iron butterfly. So you're receiving like a pretty big credit.
Okay, so you would do an iron butterfly at a directional.
That's right. It's directional. If it's up, it's a down direction butterfly. If we're down in the market, it's an up direction butterfly.
Okay, basically. I got you.
And you take 5%, or you take 5% of the premium collected, or you get out at 250. So this trade basically is a 45-minute trade, just on.
I got you.
Just on those.
And you're talking a credit of like $20 you're bringing in, right?
Yeah, because you think Vol's probably not gone down at all because Powell hasn't spoke yet, right? So Vol's still elevated, and it's so directional that you're collecting more, right?
I got you.
And so I always tell people 24 trades is nothing. You can't set a date. It's very hard to put a data set on 24 trades and trust it. But it's interesting in this because
Troy, one thing. So you're so your premium is around $20 and you're looking to make 5% of this. You're looking to make $1.
Yeah. Basically.
Right? Take $1 out of it and go. All right.
Yeah, exactly. Yeah. It's just take $1 and run.
Yeah.
That's all we're doing.
Yeah.
And your out is either way, we're going to get out 45 minutes later. Right.
Yeah.
And so you can see that really does act as a stop, because every time we do that, that's when we're losing. So it acts as a stop a little bit, but because we're only getting 5%, basically the theory, the reason I wanted to test this is on a Wednesday, a Fed day, everyone's trying to play the direction, right? But sometimes it reverses, sometimes it doesn't. But even if it doesn't reverse by the end of the day, so say for instance, it goes up and we end the day up or up bigger than that, there's usually a moment between when the Fed news itself comes out and 15 minutes into Powell's talking that there's been some reversion. That's the theory, right?
I got you.
And so it's an interest. I wanted to get your sense of that. 0-day trader, afraid of the Fed. What do you think of a trade like this? Is this a crazy? Is this crazy cool? I'd be interested in knowing.
Yeah. Now let me see it. So the results that you're showing here, we put it on. You're not in it for more than 45 minutes. It's making good capital, right?
Yeah.
It's making good money on it. But the MAR ratio isn't as good as you would want it, right?
Yeah, and that's a little tricky because you don't have a lot of dates and it's over a multi-year period. So MAR gets a little skewed with those two things.
Yeah. Okay. And now let me ask you a question. All right. So I think this is fine. I mean, it's making money, right? You're only in the trade 16 stinking minutes, right?
Yeah. Yeah.
I mean, so it's an effective trade. When you look at the ending capital to starting, the minutes in the trade, everything looks wonderful. Is a low MAR meaning, is that tied to the drawdown?
Well, and MAR's tied to the capital too. So the one thing to take into consideration is I'm only allocating 10% of the capital to this.
Oh, so you're trading basically out of 100 grand, you're trading 10 grand.
Exactly.
Which is reasonable. Which is same.
I would probably on a Fed day wouldn't do 100% of my capital on one trade. But it'd be interesting. Now you've got, so that's what happens if you put 100% in.
What if you did 5% of your capital? Because to me, these are pretty speculative.
They are.
I might even speculative. Instead of 10%, if you go 5% of your capital.
Yeah. You actually do a little bit better.
You mean in the MAR a little bit?
Yeah. Yeah, it's a little bit of a better trade.
But it's still a good trade.
Yeah, I think it's for people who are sitting on their hands on a Fed, options involve risks. I'm not saying you should trade this, but I like to think of ideas like this as, everyone thinks of the Fed days like, oh, it's going to move 80 points. It might move 80 points, but Dan, what happened Wednesday? We were up 50. Wednesday actually is kind of how this works. We were up 50, I think, at some point.
Yeah.
And then we finished the day, down 10?
Yeah.
That would have been it would have been a winner,
Yeah, I like the whole reversion to the means, Troy. What I'd be interested in, and maybe let's try something different, keep the same trade, right? So you're basically saying wherever we open, right, you're going to put on basically putting on a 25 wide iron butterfly, aren't you?
Mm-hmm.
Is that right? All right. So what if we did it instead of putting it on, that reversion to the mean and saying we're going to put it on around when the Fed is coming out, so we're going to be in it when the tornado comes out. What if we put it on at 9:32, right? Because a lot of times, at least I would conceptually think, a lot of times when you put it on at 5:30, the market doesn't do much until the Fed comes out. It's kind of in a holding pattern. What if we did it at 9:32, which would still be at the parameter, wherever we open, right?
Yeah. Yeah.
And maybe stay in it no more than, I don't know, hour and a half or something.
So go ahead and get out before the 10%. Or before the 250. Okay.
Oh, absolutely. No. If I put it on at 9:32, we could try two different times, but if I put it at 9:32, I don't want to be in for more than a half hour. I'd like to try it at 9:32, stay in no more than an hour and a half, but then also, now are we saying 9:32? Is it Central or Eastern on that thing?
It's Eastern, so it's always market time.
All right. So I'd like to do 9:32 for an hour and a half and then put 11 Eastern for an hour and a half and see if those do anything to the. So in other words, you're getting out of Dodge before Powell. You just put it on based on the opening. You're saying, hey, I think it'll be quiet, but until the Fed speaks. And again,
Yeah.
you can use this on and see what that does.
I think it didn't like my days there. Let me do this real quick. I'm going to do it this way. Do you have a lot of people who trade during the Fed, Dan, or is it?
No, because we do range bound stuff. So it's
Yeah.
usually stay in the house and close the doors,
Yeah.
until, because it's not for a range bound trader. You don't want, usually you try to, you're a little more conservative.
Right.
0-day traders they're more John Wayne personality, I think.
Let me try one more thing. I think this test, I think I blew it up with something I just did.
But
I'll go
yeah, I
back.
was just thinking.
That'll be interesting. I'll show you one real quick that is a 932. Well, that one's.
Yeah. But the other thing is just thinking at some point to test, a lot of times when you have big news coming out in a particular week, if there's a day or two before the news kicks in, those seem to be good, at least from memory, would be good for 0-day, right? Because people are like in a holding pattern until all this stuff comes out, right?
Yeah.
I don't know.
Well, my screen went black here for a second. Actually, do you go back to Thinkorswim for a second, Dan? Because I think my screen just I think the Fed days. Powell's watching my trade here. I don't think Powell likes my trade.
Powell likes. Let me see on my screen because I don't see our faces. Let me see if I minimize. Okay, there we are. And then if I go, if I want to share my screen, let's see.
Those panes to the left. I see you, so just untoggle me, and then we'll be okay.
Okay, and I can bring up. Alrighty, have to click that.
There you go.
You
yeah, that idea of mean reversion. I'll show you another one here in a minute of an idea of ones where it tries to go a little bit, and maybe the market.
Do you want to look at that now? Do you have it going, or do you want me to go?
No, I'm still working on it here. Okay. But anyway, that idea of trading during the Fed is interesting to me, in general.
Oh yeah, I think there's a couple ways. You almost, what I'd like to know is, do you say, okay, in the morning for a couple hours, at least I would think there's not a lot of movement. Maybe you can take some money out of that way, right?
Yeah.
Just it's not moving much, but then playing that reversion to the mean, which is a little more directional. So the morning butterfly would be at the money, right?
Right.
And just trying to soak out some decay, but that the Fed butterfly would be reversion to the mean. I like that because it just seems like you get a lot of wet. It's almost like Troy in that last hour. After the chairman speaks, you might have a couple whips going on. So at some point, it'll hit that point, right? It's,
yeah.
It's like Ricochet Rabbit or something.
I very rarely do I feel like they just make the announcement and Powell doesn't affect it, the other way at all. Like I just think that's a very rare thing that happens.
Oh yeah.
But I'll show you the other one real quick if you want to share one more time. Sorry about that.
No problem.
I was talking to my partner Matt. I think there might be a region down or something for the app. So, but I can show you what this is. I can't run any test right now, but
go ahead, Troy. You got it.
Yeah. So basically, this other one, this one's a little crazier, Dan. This is. I don't know if you're gonna like this one or not, but I'm willing to submit it to you. So this is a trade that you do put on in the morning of the Fed, and you put it on at 9:45. And you basically are doing two things. you're buying a ratio spread, or buying a ratio spread, and then you're buying a put calendar. And so if you look at this, you basically are selling the 10 delta. You're doing a 7-9 double calendar, a 7-9 put calendar. So you're saying, I'm selling the 10 delta next Wednesday's expiration put, and I'm buying next Friday's put at the same strike. And then you are doing a ratio. So you're selling a 50 delta 7-day put, and you're buying the put above the 25 delta put above that.
Okay.
And so you're doing this thing where you kind of get, the goal is to say, basically, you collect a small credit. In fact, let me switch that real quick and see if that actually changes it, because I think I had it as puts. This might be able to work a little bit. The idea, Dan, is I was wondering if you could construct a trade where you basically collect a credit and you are good in any direction. That's my goal. So does that make sense at all? This idea of saying a put calendar and then a 1-2 ratio of calls. So that ratio is the thing that's giving you the credit, and the put calendar is the thing that is the debit part of it, but it's a net credit for it.
And you're doing this what time on the day of the
9:45.
Okay, and the put calendar, just so I got the logistics, the put calendar will be, the short will be what duration?
The short of the calendar is 7 days, so a week out.
Okay, so short in the long of the calendar, 7 days again.
The long of the calendar is 9 days.
Oh, so okay, 7 versus 9. So very cheap, and that'd be a put calendar, and that's put at a 10 delta or 15.
I put 10 delta for this one.
Okay, so you have basically a very cheap. I mean, what are we talking? Like 40 cents, 50 cents?
It's probably a little more expensive than that.
Oh, it's 7 day. It's a 7-dayer.
Yeah,
right?
we could take out the calls first and just show you the put part of it. And so that'll be it'll be a small debit, but it's not going to be anything.
Yeah, small
crazy.
debit, 7 wide calendar. So you have at a 10,
and it's not 7 wide, so it's
2 wide.
2 wide. Yeah.
7 days out. Okay. And
Yeah.
then that's 10 days. And then the 1-2 ratio, what's the duration of the ratio?
7 days as well.
Okay, so 7 days. And you're buying which delta?
The 50 delta. Well, so the 10 delta put calendar.
Gotcha.
And then you're selling one of the 50 delta call. So you're getting your credit from that ratio. You're selling a 50 delta call, and you're buying 2 25 delta calls.
Oh, I got you. Buy 2 25 delta, buy 1 50 delta, buy 150, sell 225. Okay, I got you. So
I can't run any variations right now. I think there's a region down, but does that make any sense? This is where I get wild-haired sometimes with these things. And
well, I think I mean, you're doing a neutral, basically you're doing a neutral ratio spread, right?
Yeah.
You're fine there, right?
Yeah.
You're neutral, you get a credit. And then what was your thinking with because your risk in this spread is the upside, right?
Well, to a certain extent, it's the way I'm visualizing it is, without necessarily building out in a graph, is when you think of, like, if you just did the call ratio where you said there's a 50 delta and then 2 25 deltas.
And you're selling the 225s, right?
No, sorry, it's reversed. So you're selling one of the calls. The 50 delta. Sorry. No, you're fine. Then
you're buying 225. All right, so you got a back spread.
Yeah, it's back spread. Sorry.
I got you. Okay. I got you. So you got a back spread. You're getting what kind of credit are you getting? Like a couple bucks?
You're getting like $500 or $600 just because the put calendar is so cheap. You know, uh, the put calendar is so cheap on that.
I liked it. I mean, we even went out to back testing. I like it.
Well, and the
I like
interesting
it because it makes. I mean, you're talking of Feds. You're talking the back ratio 7 days out. It's not. Your risk in a back ratio is your theta and your volatility.
that's
Well,
right.
you're putting this on for a binary event, so there's not. Unless the like right now, if you told VIX is 13 or 14, and if we were something like that, I'd say beautiful. I might be a little more picky if VIX were 19, because if the news came out and vols get torched, right?
Right.
You've got that heaviness of, both of those are long Vega trades. But I like it for a 1 day thing because you've got kind of like that lucky leprechaun put calendar way down there at the 10 delta, right?
Yeah.
And you're already gonna. I mean, technically, part of my thought is, do you need the put calendar?
Well, let's test that, because that's the thing I was interested in. Is theoretically, you
Because
don't.
you got that credit of the back spread, right?
Yeah, you've got the credit of the back spread. I mean, it doesn't really necessarily change the trade too much, though. And I guess that's the thing I wasn't thinking about, is the credit of the back spread. You're collecting so much that if there's any serious move down, you're going to hit your profit target.
You're beautiful.
So really, the way that the limitation of these type of trade, like the back spread because the back spread to me for a Fed announcement actually almost seems like the perfect trade, right? Like
as long as the vol levels are reasonable, right? I mean, I would be nervous doing this. Not that you couldn't make money.
Yeah.
But I just think if VIX is, to me, if VIX was 14, 15 or below, I get it. If we were 20, 21,
yeah,
and then the Fed comes out and we go up 60 points and they torch the vol.
I think that's the thing I didn't think about. You're right. I mean, I don't know if you would want to put it on in 2022 when VIX was above 20 and it's elevated, and like every Fed decision, you're sitting here being like, well, vol could go down 25% today. I mean,
it still could work well because, like you said, over time, because, if we're in a high volume, so it comes down a little bit, if the VIX comes down a little bit, you're looking for, maybe that day or the next morning. So I don't know how much it's going to come down right away. And a big enough move can offset some of the volatility. But I think I would just at least be concerned about the volatility anytime you say the word ratio back spread, because that's your risk. Your price risk is, to me, negligible, for the 1 or 2 days. You agree? I mean, there's really no.
And the way I set this up is I took it off 2 days, and maybe that's probably not even the best case. You might want to take it off like 5 days, take it off that Friday, end of day.
Yeah, I agree with
that greatly improves it, actually.
Oh, yeah, I agree with you. Because you're putting it on for the event, and if you put it on, right, Troy, if you put it on Wednesday, you've got a little bit of Wednesday, Thursday, and Friday. That's enough. I mean, for the ratio back spread, because then, you're putting it on for a specific event. When it's over with, I wouldn't just hang around Dodge too long.
I think you're probably right. And personally speaking, if I was ever going to trade, I think I did a couple of times. The last thing I'd want to do, I don't think I ever actually did it. The last thing I'd want to do going into a weekend is just sitting on the lawn Saturday, thinking about my theta.
Oh yeah.
And just how this is just going to get wrecked Monday. So
yeah,
but it's interesting, you don't think about back spreads a lot. I mean, people, we got a guy who said this strategy is good for every day, not just Fed day. Back spreads they're a really intriguing part of options in my mind, because it's doing a bunch of different things all at once. Would you say that's one of the more complex things, Dan, understanding the Greeks and back spreads, or?
No, I tell you, here's my thoughts on back spreads. When we were in the pits at the CBOE, it sounds horrible, doesn't it? When we were in the pits, we were in the pits of when in the trading pits, as market makers, you ended up in back spreads all the time. So we traded a lot of them because, the market a lot of time, year after year it would go up, right? Slowly trending, and there's more sellers of, a lot of sellers of call options. So we would have to buy, we're the market makers specialists. We had to buy the calls and hedge them against stocks. So you have a big back spread position. So was the point. So we did a lot of back spreads, and back spreads around bit. Here's the best thing about back spreads. Back spreads are just saying, I don't know which way we're going.
Yeah.
But if we go, I'm going to make money either way, right? So they're a wonderful, wonderful trade. Now, as I move from the pits into the retail sector, once I looked at what these brokerage firms are charging you in a Reg T or margin account for a back spread margin, I said, like Lioness, or is it in Charlie Brown, UGG, UGG,
right.
because they charge you so much. Now, for people who have a portfolio margin account, I think back spreads are gold. I mean, I still think you can do them. We did a couple of them last week in SPY, but in a portfolio margin, they're gold for two reasons. One, for range bound traders, as you increase your size, we had a gentleman in our community, Joe, who last week, and one of the announcements had he had about $100,000 like a range bound trade, and that means, and so he's saying, okay, boy, my adjustments could be triggered up 40 points, down 40. We could easily move that, but by around an event overlapping a ratio back spread on top of his trade, his adjustment points suddenly went from 40 points away to 80 points away. It's like for 2 or 3 days, he hired a Navy SEAL, right? Yeah. But the stunning part of the whole thing is when you look at the margin on a back spread in a retail account, a retirement account or whatever, it's literally 5-6 times less capital on a portfolio margin. So, I mean, to me, I would trade them all the time in a portfolio margin account. I think, number one, they're a wonderful hedge against range bound trades. But number two, they're a standalone trade when either volatilities are low and you think, okay, there's some things going on, or more events. But again, you got to be careful about volatility. That's why, to me, if people talk about doing a back spread around earnings, I think they're out of their mind, right? Because yes, there's going to be a move at earnings, but the vols are jacked. And so after the event, the vols are going to come down, right?
Yeah.
So it's almost like picture Evel Knievel going over, remember that Grand Canyon jump?
Grand River Valley. Yeah.
Here's a back spread for you.
Snake River Canyon.
Pardon me?
You got me. Snake River Canyon.
Snake River Canyon. But here's a back spread for you. A back spread around earnings is basically saying Evel's got to hit those edges, right? I mean, he's got to go higher probabilities. He's got to go so far just to live. Anything in between, he's done, right?
Yeah, that's right.
That basically was the case. And the thing with back spread, if you look at any back spread and model it and say, okay, when the vols come out on the day after earnings, you basically need it to move near the expected move to break even, right? It's just a horrible trade.
Yeah.
What would be the one situation where I'd say, I think there's better ways to skin the cat, but what would be the only situation you could dream of putting a back spread on for earnings? If you say, I think they're going to blow through the expected move, right? If the expected move is 13, I think we're moving 30, right? But I think there's other better ways to skin the cat if you're going to do it. But I like, but like today, the Fed, the volatility wasn't, what was the volatility? When was the Fed meeting? This week, was it last week?
No, it's this week. It's been a week, huh, Dan? It's 2 days ago.
Wow, this is scary. I don't know what the VIX was the day the Fed thing was coming out, but I think and another thing you could do is the back spread. When did you say you're putting this on? What time?
Wednesday morning, 9:45.
Yeah. No, I think that's a good trade. Yeah, I mean, we did a couple of these this week during that type of stuff. So I think it's a good trade, Troy.
Nice.
It stinks to it's what the brokerage firms, how they margin. It misses me sometimes how these brokerage firms margin some trades.
For a one contract to have $5,000 or $6,000 margin on something like that's hedged, that's covered. I can obviously, if you're buying one and selling two, that by all means margin away. But the reverse, it's tough. But anyway, that's all I got, Dan. That's all.
No, that's good. Good stuff as always, Troy, and I appreciate it. And I'll just, if it's okay, maybe spend let me get out of the. Let's see if I can click this. Let me see. What do I need to. I'm looking for help back here, Michael. Looking for because I'm trying to find the. What am I trying to find? Where do I need to click to get the? Stay there.
I'm right here. I'm not going anywhere.
Try say, you know what? Sing a song or say something. I'm going to go grab IT.
Well, no, that's perfect. I saw someone in the chat said they had portfolios today. I don't know if that is a great options joke or if they had portfolios today. And while Dan's away, I'm ashamed to say it, but I've never had portfolios before. But I hear it's good. I don't even know if I'm pronouncing it right. Is it Portillo's?
It is Portillo's.
Portillo's.
Yeah. One second.
Okay.
All right. So let's see. Did I do your? I can share mine now. Okay.
Yeah, you're good.
All right. Let me. Do you see? You see my screen?
Yeah. Yeah.
All
and
right.
if you want to maximize it.
Okay.
You can.
Maximize it. Okay.
There you go.
All right. So real quick, maybe Troy, if you bring up, or I could bring up on, let me just look real quick. I don't think there's a lot of the earnings next week. Do you got the chat open, Troy, or can you see? Or
yeah, I can see chat.
Maybe you can see if anybody's got as far as the news for next week. Let me just bring up real quick, and then I'll get into strategies.
Sure.
Market. I don't think, a lot of the big earnings are done. If we look at Market Watch, what's next week would be 3rd, 4th, 5th, 6th. Market Watch calendar, I'm sorry. Market Watch calendar. And then I'll look at a couple quick. So as we look at next week, we're talking May, let's get into this, May 6th, May 3rd, 4th, 5th, 6th. Monday, Richmond Fed president, New York Fed president. These guys must be they're just on tour constantly. Tuesday, consumer credit. Wednesday, another Fed speaker. Thursday, initial jobless claims. Friday, consumer sentiment, monthly U.S. federal budget. So I don't see anything in there. Maybe if anybody, anything major next week or earnings. So unless anybody sees anything, if anybody says anything in the chat, try let me know. But I'll just go on here and look at least what I'm looking at next week. I think this week it looks like we'll finish in the expected move, which would be 50.18 to 51.82, which looks like that's probably pretty sure we should be in there unless we have a massive rally here in a second. So that's good. I think next week will continue to be into a range bound move. But the most significant thing, Troy, right now that I speak of is if I would have said to somebody listening here that we're going to be back in the 13s this quick, but I think, so we're back in the 13s with VIX. And part of it is just because, we've had a couple busy weeks with news, all the earnings. So I think we're settling down here. We're going to be in a little bit lower vol environment. So now in 13, I'm going to throw a little curveball. We're talking this combo strategy, but I'm going to just, now that we're in this 13s, so some trades that I'll be looking for next week. Haven't done a double calendar in a while. But so if we're at 51.30, I'd be looking at this trade on Monday with this expiration. So this would be a 4-day trade on Monday. VIX will be pretty low here. We haven't been this low in a few weeks. So instead of the combo type strategy that we've been doing to neutralize the Vega, I'm going to give a 4-day trade, and I'm going to do 2 calendars. So assuming we're Monday, so let's pretend a little bit, everybody. Pretend right now that it's Monday. So on Monday, which would be the 6th, if we do May 13, 10, you see this here, three days distance between the long and the short. I'm going 50 points up in the calls to 51.80. So this would be the mechanics of it. Go 50 points down from 51.30, 50.80. Now, a little bit lower in the middle there. I don't mind that, right? Especially if the VIX is in the 13s. But let's, we could bring this in a little bit. Brings it up a little bit. I think that's fine. But so Dan, how did you set it up? We said we'll pretend it's Monday, number one. Number two, I'm going to do 2 calendars, one bullish, one bearish. I'm going to set my short strike at next Friday, May 10, my long strike the Monday following that, May 13. May 13, 10, 51.75 on the upside. So Monday morning, 45 points up. 50.85 put, 45 points down. It's going to cost about $6.75 on this. And what I like about this, now I'm going to be long Vega, a little bit of long Vega. I don't mind being some long Vega when we're in the 13s, right? The range over the last 2-3 weeks in VIX has been about 12 to 21, 12 and a half. So we're finally at the volatility I would do something like this. Now, what else do I like about this? Dan, it's a 4-day trade. We have more price risk. I got it. But if I put it on Monday, probably 70% of the time I'd look to be out by Wednesday. So if you look at a typical 2 or 3 day expected move, what are we looking at? You're looking about, for next week, 30 points for 3 days, right? That means if I put it on Monday, I'm out by Thursday. So you've got all kinds of room here on this trade. And as I put, if we go up, I'll just give you the quick rigmarole. If we go up in this area, take off the downside, the put calendar. If we go down past the short strike, 10, 15 points, take off the call side. And I mean, that's kind of, and those have been working. The double structure has been working well. This is the first time that I'm planning on putting on a double calendar because the vols are cheaper. All right, that's trade number one. Probably put that on Monday. Tuesday, all right, Troy, we're going to do Mythbusters. You ready?
I'm ready for it.
All right, Mythbusters. We can't. I was thinking of Rolling Stones song. I don't know why you can't always get what you want. No, that's not what I mean here. You can do butterfly. You know, you think butterfly is a short vega trade, meaning as volatilities go down, you make money. But when they're down like this, people would say, well, Dan, wouldn't you rather do something like a calendar? Yes, but butterflies are very flexible. So again, giving guidelines, if when VIX is 12 to, let's say, 15 range, it's very clear which way the SPX is going. Up. Show me a 12 to 14, 12 to 15, we're in a market correction or we're going down much. We're not, right? So 12 to 15, I would go, here's May 31st. I would look on Monday, right? So Monday, I would look for something, around this 24 to 28 days. And I would be looking and doing a butterfly, a 70-60 butterfly. Again, they're specially made for when VIX is 12 to 15. Doesn't mean they can't do well other levels, but this would be when I would more heavily focus. So if we're at 51.30, sell the 51.30s. Go down 70 to 50.60. And go up 60 to 51.90. And you can see what's beautiful about these. Not only are they neutral, but again, they're neutral, but it costs about $1,500, but the upside risk is, in the fives. So the reason they feel warm and fuzzy as the market goes up is because they should. You have 3 times less risk, and the upside are easily manageable. So those are some of the trades that I'll be looking at next week. And wow, I'm still amazed. I'm looking here, Troy, we're at 13 stinking VIX. It's cheap. But folks, I want to encourage you, next week, we've got, if you go to SheridanRiskManagement.com, and on the top tab, if you want to join us next week, try for a month. We have 9:50 Eastern every day. We go an hour where we're looking at live trades, going over all our live trades that we're putting on during the classes, looking at other students' trades, a lot of stuff in that first hour. And that's Monday through Thursday. And then every day at 2, we have 4 classes working this month. Every month or 2, we'll change classes. We have the combo class on Monday and Tuesdays at 2 p.m., a class similar to the 10%, a 3K class. It's called Strategies at Market Highs. Wednesday, we have Managed by the Greeks, and Thursday, Short-Term Iron Condors. What's wonderful is we've had 3 weeks of doing it so far, and it's been going great. Trades have been going great. But I think, so what I said is the next 4 weeks through May will continue on these 4 courses. And so we're learning a lot on all the different things. But to keep it in this plan of it, we're starting this Monday, the 10,000K portfolio, and you can see kind of the structure, just organizing what we're already doing, which would be Monday, a type of a combo strategy, Tuesday, a fly, Wednesday, a calendar, and Thursday would be the short-term iron condor. So what it's working out is that Monday trade will be a generally a 4-day trade, the combo. Tuesday, the butterfly will be anywhere from 3 to 4 weeks. The on the Managed by the Greeks class on Wednesday, we've been doing a calendar. That'd be about 16 days out. And then the short-term iron condor, probably stick with 6 days. And so you'll be able to get that repetition the Monday, the Tuesday, the Wednesday, the Thursday, and you could just do one of them. So with our subscription rate, if you go on there, you get everything. You get all our on-demand classes, you get the live classes, and you get that 9 Eastern and 2 Eastern every day. So, but what's nice is whether you're, and we have a beginner's class every Friday at 12, and then we have a beginner's library. So that will help the beginners. And what also helps the beginners is we're putting a live trade on in every class. So it's really, if you're looking for something very practical to go side by side as you go through the journey, this could be a big help to you. So Troy, I hand it over to you. Thanks for helping today. And thanks everybody for coming in. If there's any questions, Troy, I didn't see you. Let me know. Or
no, everybody's doing good so far. But yeah, I put in the link in the notes there, the website, and like Dan said, it's pretty unique in the sense of there's not many places where you have, you can really show off your trade and get someone with Dan's knowledge to help you with it. So that alone is worth the price of admission in my mind. But that's all I got, Dan.
All
and
right,
then
Troy.
next we'll be on next week, and I think there might be a special guest, much more special than me, but you have to wait and see who that is.
We're going to have Jesse, the Body Ventura, will be on.
Oh, I'm gonna go ahead and say I'm more special than him.
Yeah, that's right.
Anybody else? Yeah. Anybody else?
Yeah. All right, Troy. We'll see you. Thanks,
Dan, have a good
everybody.
day.
Appreciate
Bye-bye.
it. Have a nice week.